Good evening, all the joinees. Hi, this is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. So before we, really delve into the webinar topic, we will just introduce our topic for today. We'll let others join in the meanwhile. So our topic for today will revolve around comparing performance of two portfolios side by side. We will actually see how, with respect to multiple parameters like performance, Sharpe ratio, annual returns, exposures in various sectors. How do these two portfolios match up with each other, and what are the comparative statistics of all of these two portfolios? Next, we will move over and understand how the rolling returns analysis with respect to 6 months and 1 year rolling. What are the highest average returns that these portfolios would have generated? What are the strengths of these two portfolios to recover from each of their drawdowns that they would have experienced, and how did they recover from that particular drawdowns? That's about the second subtopic in the webinar. And then lastly, we will have a look at, after the analysis of the entire side by side comparison of these two portfolios, we will understand how we can generate actionable proposals with respect to some PDF export options that you can do, and actually actively acquire new business. So for comparing two portfolios, you can either do it for a prospective client's existing portfolio versus a proposed or a model portfolio that you would have created. That is one option. Secondly, what you can also do is you can compare maybe your existing client, so is already investing through you, his portfolio, you can just improve it, optimize it using our optimization function that I will just show it to you at the start of the webinar itself. And you can compare two optimized portfolios and generate an actionable plan. Okay, look, this is the existing portfolio. You can tell the client that, look, this is the existing portfolio, these are the returns that you would have generated, and now this is the proposed portfolio. If that is something that you would have invested in, this would have been the return differential. Okay, and that you can perfectly do in percentage terms as well as amount in rupees terms, because that is typically more relatable for the clients. Lastly, we'll definitely throw the forum open for a Q&A session, wherein you can ask your questions by either unmuting yourself or by typing in your questions in the chat box. So let us now begin. For that, I'm just heading over to the NGEN Markets terminal. So this is the NGEN Markets platform, and for today's a webinar sake, we will typically be focusing on the portfolio section, where first of all I'll tell you how you can optimize or improve this portfolio, and then we will head over to the comparing two portfolios part. So let me just load in a portfolio. So for an example, I have loaded in test portfolio. This is an example portfolio that I've created. Once this is loaded, there are multiple options. Of course, you can definitely analyze the portfolio against the benchmark. All of it is definitely there. But if you want to quickly know what should be the optimal allocation of this portfolio in order to either maximize return or minimize volatility or maximize Sharpe ratio, that really depends upon the client objective that you're trying to address. So typically for an aggressive client, you would definitely like to go over and check what would be the maximum returns that would be generated by the funds in the portfolio, and then allocate accordingly to that particular portfolio. On the other hand, if you're building this portfolio or trying to recommend this portfolio for a conservative client or a risk averse client, you will typically go ahead with a minimum volatility model, which will typically minimize the volatility in the portfolio and then accordingly suggest the weights. So for that, I have clicked on optimize or improve function right beside the name of the portfolio. When I click on that, this optimization feature gets open. So let me just interpret this, each of the functions for you. So first of all, in this first column, we have original weightages. So what do we mean by original? Is considering a start date of 1st of January 2018, if we run an hypothetical historical back test on this portfolio, what we can actually see is the returns that this portfolio generates would be 11.79%. Of course, all of this has already happened, historical performance. So on the basis of, how did this portfolio generate a return of 11.79? That's because the underlying schemes in the portfolio were these: HDFC arbitrage, SBI equity hybrid, for example, and so on and so forth. So total 13 schemes we have. out of these 13, these were the allocations of the respective schemes. So in this case, what we can see is the original allocation of the portfolio is 60% towards one single fund, which is SBI Equity Hybrid Fund. And therefore, this particular return was generated by this portfolio. So here, this is the annual return that was generated by this portfolio. This return was generated by taking in a risk of how much? So that will be definitely indicated by the volatility parameter right here. So by volatility, we mean the standard deviation of the portfolio returns from its average returns. So that typically means what is the risk that the portfolio has to generate these amount of returns. So that the volatility is 13.15%. And now return is considered, volatility or risk is independently considered. Now we have third parameter, which is Sharpe ratio. So Sharpe ratio is risk adjusted returns that are generated by this particular portfolio over a time period of the last 5.5 years that we have considered here. So input data is from 1st of January 2018. That means we've considered 5.5 years. So what we can actually see is, to generate so much of return, considering this amount of risk, what were the risk adjusted returns? So what was the risk that this portfolio took to generate per unit of return? So higher the Sharpe ratio, better it is. That is what is the general norm typically for all the portfolios which are equity asset class portfolios. Okay, so in this case, we can see that the Sharpe ratio, the existing Sharpe ratio is a 0.36%. 0.36, sorry. So now to achieve all of these were the weightages of the portfolio components. Now let us move over to the ranking models and the value models. So first of all, we have two models, which is ranking model and the value model. And of course, the third and the last model is equal weightage model. So what this tells you is, if the weightages in the portfolio were assumed to be equal, okay, instead of some lopsided weightages like a 60% to one particular fund and a very, very low weightage of let's say only 0.23 to a Mirai asset emerging fund. If each of the components in the portfolio were given equal weightages, what would be the return of the portfolio? Of course, held from 5.5 years, that's typically from 1st of January 2018. So what this says is that the portfolio had a potential of generating 12.01% return if the weightages would have been equal. Each of the components in the portfolio, as you can see, are given equal weightages in this case. So in this case, we can actually see that even by giving equal weightages, the portfolio return has somewhat improved, even if it's 0.30%. Still, it is definitely an improvement from the overall original portfolio return. On the other hand, the volatility, we have actually managed to minimize, not minimize, at least it has reduced at least a 1%, 1% volatility is definitely reduced. On the other hand, the Sharpe ratio is definitely improved. So what we can see is, if we even go ahead and mindlessly invest equal in each of the component in the portfolio, it still gives a better return as compared to the original portfolio. Now, let me explain the ranking models and the value models. So what ranking models, follow an approach of is a pretty concentrated approach. So what do I mean by concentrated approach? Is if we consider rank returns, for an example, which is the first sub model in the ranking models, what this aims to do is, it will aim to maximize the return of the portfolio irrespective of any other parameters. So irrespective of the fact the volatility gets increased, fine, I don't care. Okay, I just care about the returns. This is what the model says. So for an example, as you can see in this case, ranking returns, the overall returns of the portfolio have improved to a 16.79%. That's practically a 5% improvement from the original portfolio weightages. So what we can see is, how did we come up to a 16.79% return? For that, definitely the annual volatility of the portfolio increased from a 13 to a 14%. So what we can typically see is, with just a 1% increase in the volatility or the risk of the portfolio, incremental return was given to an extent of 5%. Okay, and to achieve that, how was the allocation in the portfolio? So in this case, we can see that the highest allocation is being made to quant small cap fund. So for the time period under consideration, 1st of January 2018 onwards, quant would have given the best return among the entire lot that we have here. And therefore, this particular model is giving the highest amount of weightage among all the 13 items to this quant small cap fund as a particular component in the portfolio. So as you can see, the allocation is 31.45. Now, the second highest allocation is to Parag Parikh Flexi Cap Fund, which would have given the second best returns in this entire universe. And therefore, it has been given a weightage of 15.72%. And so on and so forth for each of the components in the portfolio. And we can see the least weightage is somewhere given to this one. So that's a HDFC arbitrage fund that has been given a weightage of 2.42%. And therefore, the returns that were generated by this portfolio now come to 16.79. On the other hand, if you were to really, check or build this particular, optimize this particular portfolio for, suggesting it to a conservative client, then definitely the motive or the objective will be to minimize the volatility to as low as possible. And how can that be ensured? That can be ensured by following the minimum volatility model, which is right here, the second model. This always, by the way, has to be read as volatility, and this is not volume. So, everywhere on this platform, wherever you see VOL, it's volatility and not volume. So this is the minimum volatility model. What that has done typically is it has literally halved the volatility of the original portfolio of a 13.15% to a 6.45%. That's typically a reduction of more than 6% in the volatility of the overall portfolio. That typically means that the risk of the portfolio is now minimized. And to minimize this risk to a level of 6.45%, which of the fund has been given the highest weightage? If you see that, you will see that 31.45% weightage is being given to HDFC arbitrage fund, right? So it has the minimum volatility, and therefore it has been given the highest weightage to achieve this particular volatility. And we can see that definitely the returns have reduced, but that has come at a cost of reducing the volatility by 6%. And on the other hand, the returns have reduced by a meager 2%. Right. So that's definitely something that is worth considering, at least for a conservative client. Right. That's the minimum volatility model. The third model is, of course, the rank sharp model. What rank sharp model is doing is it is maximizing the Sharpe ratio of this particular portfolio. So as you can see, the original Sharpe ratio is 0.36. On the other hand, the optimized Sharpe ratio is 0.67. Right. So that means, as we just discussed, higher the Sharpe ratio, the better it is. And that's why it has maximized the Sharpe ratio for this particular portfolio. And how did it achieve this? It achieved this by allocating the highest number of allocation to that particular fund, which would have the highest Sharpe ratio among this entire universe. So as you can see, it is being allocated to a quant small cap fund. Of course, this will be more or less similar to the ranking returns model. But of course, as you can see, there are some amount of deviations that will typically depend upon the risk versus return profiling of each of these funds. So as you can see, PGIM India Midcap Opportunities has been given a 10% weightage in a ranking returns model. However, it has been given only a 7.86% weightage in a rank sharp model. Why is that so? That's because the returns, if only returns are taken into consideration, it definitely has better returns. But if risk adjusted returns are taken into consideration, okay, that means returns per unit of risk. If that is taken into consideration, PGIM has a lower Sharpe ratio, and therefore it has been given a lower allocation of a 7.86% in a rank sharp model. Now, this was the explanation of the ranking models. So on the similar terms of value models, definitely the logic is just the same. It's just that the calculation methodology varies. So rank value will definitely rank these particular funds on the basis of highest returns in terms of values. Right. Minimum volatility will definitely aim to minimize the volatility of the entire portfolio on the basis of the underlying exposures and their actual volatility numbers. And the Sharpe ratio value will definitely take into consideration the actual Sharpe ratios of each of these funds and allocate that much weightage to each of these funds on the basis of their Sharpe ratios. So that's how optimization model works. So now let me just load in one more portfolio and actually, compare two portfolios side by side, which is ultimately what we are trying to do today. So for that, I'm just loading in one of the existing clients' portfolio. So I just click on drop down, I click on run. Okay, when I click on run, the entire detailed portfolio analytics will get run. But today what we are trying to address is how to compare two portfolios. So as you can see here, It's an equal weighted portfolio. So all of the 10 components in the portfolio are given an equal weightage. So now let's optimize this. Let me optimize this on the basis of two models. So first, I'm going to just click on improve. When I click on improve, this will try to run a improvisation or a optimization function from the start period, which is the minimum common start period of all the components taken together in the portfolio. So we can see that the youngest fund in this portfolio was listed or launched on 17th of October 2019, and therefore this model is running from that particular date. Now let me just choose a start date, common start date. So I want to run this analysis from January of 2020. So I just choose whatever is the start date that I want to plan. So it's 1st of January 2020. That's the date from when I want to run this analysis. I just put in that date and I click on rerun. So now this analysis will, the historical back testing will run from 1st of January 2020. And you can see this has gotten run. And I can see that the original returns is 18.01 and the optimized return in case of ranking returns is a 28.43%. Now what I will do is I will save these optimal allocations. So, once you have run this optimization, you also have an option to save these optimal allocations that have been suggested by the model. And by the way, please note, we are neither adding any new fund nor are we deleting any fund from this particular list to actually achieve this much of a better return. Okay, so when I just click on save, it prompts me to name the portfolio. Of course, default it will be saved as the name of the portfolio dash optimized. So let me just name this as optimized return, and I click on create. Once I do that, this portfolio will definitely be saved in your portfolio section, because we have saved this from the improvised model that we have just seen. It will be definitely saved in the improve folder. How do you locate that folder? Just click on collapse all, which is at the top. This is a dynamic folder management system that we have. If you click on collapse all, you will see all the active, all the folders that are currently there. So because this was created from the improve option, just click on this and you will see that existing client portfolio 1.1 optimized return. This was the one that we just created. Okay, this has now gotten saved. Now I want to do a vis-a-vis comparison of the non-optimized portfolio versus a optimized portfolio. How will I do that? For that, I will directly head over to compare two portfolios, which is at the top panel in the portfolio section. Okay, right here. When I click on this, it will take me to a compare to portfolio side-by-side option, which is ultimately there in the compare section. Okay, so in the compare section, first of all, in the compare portfolio section specifically, I will load in the non-optimized portfolio on the left-hand side. Okay, so for that, I'll just search for this. So, okay, so this was the client, existing client portfolio 1.1. This was typically the portfolio with equal weightages, and I had not done any optimization. Now I will just load in another portfolio which we just optimized. So I'll just search for the name of it. Existing client portfolio optimized 1.1. And then again, I'll ensure that my start date is again same. So for that, I'll just go here, and because we were doing this analysis from January of 2020, I'll just choose the same start date and I click on go. Okay, so now what this typically says is we are now comparing these two portfolios side by side. As you can see, number of positions in the portfolio are not changed. We have typically maintained same funds. We have just reallocated their weightage in the portfolio to a optimized weightage. So we can see that with that, in the time period under consideration, that's 1st of January 2020 to 20th of July 2023, the annual return differential between two portfolios is to an extent of close to 10.5%. Okay, and when we just hover on this icon, what we actually see is this is the difference of simple annual average returns of the second portfolio versus the first portfolio. And therefore, that's the reason I said that the non-optimized portfolio is the one that you should load on the left hand side, and the optimized portfolio, or in case of model portfolio, you should always load the model portfolio on the right hand side. Okay. So I'll just interpret this for you. So there's an annual return differential of a 10.5% with the optimized portfolio against the existing existing portfolio, which is non-optimized, of course. The month to date differentials are definitely highlighted here. So for that, you will have to definitely check these tabulated manner in this chart that is, sorry, in this table that is created here. So first of all, the orange line, which is the existing client's portfolio optimized return, which is plotted right here. This is the orange line for the optimized portfolio. On the other hand, the existing client portfolio is the green line, which is non-optimized. Okay, the Sharpe ratio differential between these two for a time period of 3.5 years is a 0.39% better Sharpe ratio is being given by the optimized portfolio versus the original portfolio. That can definitely be highlighted here as well. So just locate Sharpe ratio as a parameter. So in this case, Sharpe ratio is right here. The existing Sharpe ratio, non-optimized portfolio Sharpe ratio is a 0.76. And as we just discussed, higher the Sharpe ratio, the better it is. By optimizing the portfolio, we actually improve the Sharpe ratio of this particular portfolio to 1.15. That's definitely a good thing about this portfolio, right? And after that, let's say you want to have a look at the calendar year-wise performances that are definitely highlighted here in the form of a graphical chart. So what you can typically see is in 2020 as a calendar year, the existing portfolio given a 20% return. On the other hand, the optimized portfolio given a 32% return. Similarly, for any particular year, you can check this for year-to-date performance of this current year as well. So we are almost, we're already 6 months into 2023. And we can see that 10% is the original client's portfolio, and this one 12.90 is the optimized allocation, right? Optimized return that was generated by this client's portfolio. In addition to that, what we can typically see is the cumulative return of this portfolio versus the optimized portfolio is a whooping 63.08%. So cumulative returns meaning absolute return differential between these two portfolios for the entire time period under consideration. So if you consider 3.5 years in total, so the difference was 80% versus, so 80% plays a 143%, and that comes to annual return differential of 18 versus a 28, right? You can definitely see the volatility has definitely increased, a 3% jump in the volatility, which is highlighted right here. Now moving on to asset allocation. So we can definitely check this as well for the two portfolios that we have created. So in asset allocation, what we can actually check is top equity sectors. In this case, the existing portfolio, banks as a sector is allocated to an extent of 14.32. On the other hand, in the optimized portfolio, it has an allocation of only a 13.06%. And of course, so on and so forth. So large cap, mid cap, small cap exposures are definitely highlighted here as well. So for the debt components in the portfolio, we've definitely given you the portfolio credit ratings. So in this case, we can see that the AAA rated is definitely higher in the existing non-optimized portfolio. That's to a percentage of 70%. On the other hand, in the optimized one, AAA is only a 52%. Of course, sovereign percentage has jumped up. Okay, so that can definitely be seen for the debt part of the portfolio. Next, we have the exposures. So similar to what we saw in asset allocation, this is typically given in tabulated manner, wherein you can see security-wise, which was the highest allocated security in the portfolio. So in this case, it is HDFC Bank. On the other hand, in this particular optimized portfolio, it's Reliance Industries to an extent of 5.08%. Now moving on to the most crucial parts of comparison, which is rolling returns analysis and drawdowns analysis. So when we go to rolling returns, what we can actually see is there are, of course, two periods that are taken into consideration, 6 months and 1 year, which is definitely highlighted here. So you can see this black line over here, which actually differentiates this portfolio from the optimized portfolio. So everything lying on the left-hand side will be the statistics of the existing portfolio. So in this case, we can see that the average returns that were generated by this portfolio on a 6-month basis are 9.78%. On the other hand, the average 6-month rolling returns that are generated by this optimized portfolio are to an extent of 14.56. On the other hand, 1 year returns, as you can see, is a 19, plays a 29. So that's definitely a differential of a 10%. Right. On the other hand, the highest that this portfolio has ever given in a 1 year rolling period from, of course, the start date that we have chosen, that's 1st of Jan 2020, 57 highest return, 57% was the highest return that was generated by this portfolio. Mind you, the exposures are, just the same. Basically, we have not added any funds, neither have we deleted any funds. We've just optimized the allocation in the funds, right? On the other hand, the highest returns in this case would have been 77%, or considering 1 year rolling returns. Okay, that's a rolling returns differential that you can highlight. Of course, I'm not ignoring the fact that the lowest that this portfolio has ever gone has also increased, but that really makes sense, because the volatility overall of the portfolio has increased, and as we move more towards a concentrated returns approach, as we move on towards the aggressive model, we'll definitely see that the lowest that this portfolio has ever gone has definitely increased in by a 2%, right, which is highlighted here as well. Next, moving on to drawdowns analysis. For that, directly head over to this particular drawdowns tab, and you can actually see what have been the magnitudes of the losses that were faced by these two portfolios over the time period that we have chosen. So currently, this is running 5 worst drawdowns from the start date of 1st of Jan 2020. Now, if we were to change the start date, the drawdown, dates will definitely change. So in this case, what we can see is, if we consider from 1st of January 2020, the worst drawdown was of a size of 28% in case of this existing portfolio, which started on 12th of February 2020 and ended on 23rd of March 2020. That's typically within a month. And you can see it's a comparable drawdown here and here as well, both places, right? So similar periods under consideration. This particular portfolio had a drawdown of a 28%, which ultimately the portfolio recovered from this particular drawdown in 109 working days. Okay, that typically indicates the strength of the portfolio to recover from any particular loss. Okay, on the other hand, in this case, this particular optimized portfolio recovered from this loss of a worst loss, basically, of a 33% within 99 working days. That definitely speaks a little about the strength of this particular portfolio to recover from the losses. So this is the analysis that you can definitely do. So I currently did an analysis of optimized portfolio versus the existing portfolio. You can typically, either load in a prospective client's existing portfolio versus the model portfolio that you would have suggested. So, the functionalities are definitely there given. You just have to explore. So for an example, I will just show how you can do it for an existing client's portfolio and a proposed portfolio. Just, load in the existing client's portfolio. So, let's just assume that this is the existing clients, the prospective client's existing portfolio. This is the client that you're trying to acquire. This is his existing portfolio. On the other hand, you have, come up with a model portfolio that's for this particular client. And that particular model portfolio is probably saved as a proposed portfolio. So just load that up here and load it. Once you load this particular portfolio and just highlight, okay, so this analysis is from, let's say, 2018, let's say 1st of July. And click on go. And then you can definitely highlight with respect to the performance of these two portfolios, what would be the differentials. You just have to, head over to the performance chart, and this is how it will definitely show up. Once this is generated, this analysis is what you can definitely do, and you can then directly head over to creating reports out of this. Okay, this analysis is what you've done, but ultimately, how will you present this to the client? How will you pick up checks from the client? For that, you will have to present this to the client in the form of an actionable proposal. So for that, we have given you a create PDF option. So when you click on create PDF, this small window will definitely open up, and there are two options that are being given. So first is creating a standard PDF. So what standard PDF will do is it will download these entire analytics that we just did for comparing two portfolios vis-a-vis. The analytics will definitely get exported, but the proposal will definitely in the form of percentage. So I've just opened this PDF, and this is how it will look. Of course, not to repeat, all of these reports that you generate will be co-branded. Whatever reports that you generate will be co-branded from our platform. So you'll have your own company name and logo here. These are the statistics, return differential statistics that we just discussed for the existing clients portfolio versus a proposed portfolio, the differentials between them, their asset allocation differentials, all of that is highlighted. Once this analysis is done, the last page of this particular PDF will actually act like a proposal. So of course, as you can see, this is in percentage term. So this will definitely help the client to understand where is it exposure coming from in his existing portfolio versus what are you trying to propose. This is of course in percentage. At times what happens is clients are a little bit more comfortable if the presentation is made in amount in rupee terms. So we have given a provision for that also. You can generate a percentage based PDF by just clicking on standard PDF. But now if you want to create an amount based PDF, then what you can do is put in the client's AUM right here in amount terms. So for an example, this particular client has an AUM of, let's say, 10 lakh rupees. So just put in 10 lakh rupees right here. And now instead of clicking on standard PDF, click on go. Okay. When you do that, of course, a PDF will get downloaded once again. When you click on this, of course, the analytics is going to be the same. The basically top 3 pages are going to be the same. The game changer is going to be the last one. This is the last page, which will actually now be in amount in rupees terms. So whatever amount you put, it will definitely capture and distribute that in on the basis of these percentages, right? That is how is an actionable proposal that you can definitely generate for your clients, and then pitch these particular model portfolios and pick up checks. And that's how you acquire a particular prospective client. Of course, I have definitely highlighted how you can generate these proposals. But let's say you want to, present only one particular tab of this. Okay, so let's say you do not want to present this entire amount-based PDF, or you do not want to go to PDFs. So you want to show this entire analytics in this manner only, right? These color coded and all of that. So in that case, we have given you every single tab pay screenshot options. So basically, let's say you want to highlight only drawdowns analysis, okay, in front of your client. So in this case, what you can see is this existing portfolio, in this case historically, has taken more than 300 days to recover its loss. And on the other hand, this proposed portfolio has never taken more than 105 odd days to recover any particular loss. And you think that this is a page that needs to be highlighted, and that's very, very important. Then what you can actually do is just head over to drawdowns tab and then click on screenshot. When you do that, a section specific screenshot will get downloaded. Of course, you'll not have anything else but drawdowns analysis only. I will just show it to you how this looks like. So let me just click on this. So this is how it will look. So this is how you can definitely share this on the fly. So this is a screenshot. Just take this, send this on a WhatsApp to the client, or maybe send this on email as well. So this will work there as well. So you can definitely highlight this particular section as well. So this is definitely going to be there for each and every section on this particular analysis. So let's say you want to highlight this, just go on this particular section, click on screenshot, and your job is done. So this is the typical analysis that we did for existing clients portfolio or a proposed portfolio versus the prospective's existing portfolio. You can typically do this for a stocks portfolio versus a proposed mutual funds portfolio as well. So for an example, let's say currently the client is investing only in stocks, okay, and not into mutual funds, but you want to move him to mutual funds and actually say that, look, mutual funds sahi hai indeed. So how do you do that? Just load in his existing stocks portfolio on the left hand side. I'll just show you an example. So I have a stocks portfolio saved, and therefore I am just loading it here on the left hand side. And when I load it, it will just come here. And let's say we want to run this analysis from, let's say, 21 of July, and I click on go. And I can typically highlight, look, this is your stocks only portfolio, and this is the mutual funds portfolio that I'm trying to suggest. Okay, and then these are the differentials between two. These are the annual return differentials, Sharpe ratio differentials, and let's say your particular portfolio, in this case, this is a clear cut indication that you can definitely highlight. So in this case, you can see that the stocks only portfolio in 2022 actually gave it a negative 15.89% return. On the other hand, the mutual funds portfolio that we have loaded right here has actually given, of course, a little bit, but a positive return. That's a 5.23% positive return. So this is something that you can definitely highlight. So the functionalities are unlimited. You just have to explore. Just go head over to portfolio section, head over to compare two portfolios, and then do the analysis, whatever you please. So that's typically about it from my side for the topic specific webinar. So if you have any questions, please go ahead. You can either do so by typing in your questions in the chat box, or unmuting yourself to speak. Thank you.
If there are any questions, please let us know. Okay, it doesn't look like there are any questions. So Prajakta, we can close for today.
Sure. So thank you everyone for taking time out for this webinar. You can definitely find the recordings of the past webinars that we have taken on our YouTube channel. So you can definitely directly search NGEN Markets on YouTube, or you can head over to on the platform. There's a YouTube videos icon. Just head over to that, and you'll be taken to our YouTube channel. Just go on playlists, and we have a dedicated playlist for webinar videos. Of course, these will be longer videos, and you'll have all these videos right here, saved right here. So you can definitely go through them. On the other hand, we also have shorts. So we have 1 odd minute videos uploaded on our YouTube channel as well. So when you just head over to the YouTube channel, you'll see a dedicated playlist, one more dedicated playlist created only for shorts. So these will be typically 1 odd minute short videos, which will definitely help you in navigating through the software better if you get stuck on some particular section. So thank you very much for joining in. Have a great weekend ahead.